Hey guys, what's up? Welcome to another episode with me, Shashank Udappa. And in today's episode, we will do a deep dive of what DIIs are buying in the country. And we will look at three interesting stocks and we will look at 4 or 5 different triggers that are affecting these stocks as well. And in the past, we made a video on pharma. If you had not watched it, please check it out because we believe a very good rally in pharma is yet to come. And we did a very good deep dive about the whole US pharma generic problem. But nonetheless, let's quickly jump into this video. And for all the people who are watching this, as you know, the market has not done a very good job this year. Nifty has been pretty flat, in fact, negative as well. Even Nifty 500 has been pretty flat, almost at 0%. And we launched small cases last year, which has done phenomenally well over the last 1 year period. Whether it's our flagship fluid baskets or even the mutual fund basket or even the thematic Bharat 2050 basket, all of them have beaten the benchmark index. So we are very proud and happy to say that. But still a long way to go because 1 year's performance doesn't mean anything. But this year we have done a good job. If you want to know more about this, I will give you a coupon code in the comment section. You can check it out as well. Now, let's quickly begin as well. Now, the first company we're going to look at is a company called Groww. They had recently given out the result as well. It has now reached a 1,25,000 market cap company, trading at still 51p because the PAT expansion is coming out really well. And if we go down, let's not look at anything else. First, let's see the DII buying. If you see, the DIIs have come in from 4.92% to now 10.08%. So a lot of DII buying has happened in this company. And the best part, whenever a DII or an FII buys a company, it should ideally be bought from the public shareholding. The more it is bought from public shareholding, the faster the stock will actually start moving up. And we can see here that the FIIs also have gone to 6.89 from 3%, and DII has gone from 4 to 5% to 10%. So DII has doubled and FII has doubled, and public shareholding has gone from 64 to 54. All three giving very good signs that the DIIs and FIIs are currently buying from market. Promoters still hold 27% of this company. Now let's get into the understanding of what is happening with this company. So as you know, I have made a deep document for this. I will share this document with all of you guys as well. Now first, let me quickly show you a table as to where their revenue comes from. Okay, so Groww basically started in 2016 as a mutual fund distributor. In 2021, they launched their broking business and then it became the fastest and the largest growing broker by FY24. And now they are building the next stage, which is complete wealth management industry, right? Now, where do they make money from? Let's understand this. So let's see what is their market share right now in all of this, right? If you look at the derivatives market, as per their shareholdings on July 15th, they have 52% of the market share as of today, and they charge 20 rupees flat fee per F&O order. If you look at stocks, which is purely cash based, they have 16% market share and 20 rupees per order. If you look at MTF, they have 8% of market share. Last year they had 3%, this year they have 8%, and they are charging 14.95% per annum interest on the funded book, which is quite a bit. If you look at commodity derivatives, 8.1% market share. Last time they were 0, now they're at 8.1%, and their float income is growing. Then they started something called loan against securities, which has gone up to 4.9% market share, again making a lot of interest on secured against securities. And now they have recently started their AMC, and they have acquired a wealth management company as well. So all of this is basically now coming into the picture. Coming to the financial performance, let's look at how they have been growing in the quarterly results. So as you can see, this quarter results, they have got 66% top line growth. Now, a lot of people think Groww is equal to brokerage. Please understand, nobody is making money only from brokerage in today's date because the market itself is doing so bad. So brokerage income to nahi aayega. So where are they making money from? As I told you, majority of their money is actually coming from loan against securities, the AMC that they have launched, and the MTF business. That is growing a lot. I don't even know how that people are currently taking a lot of loans, MTF, to actually trade in the market. So leverage has come into the market a lot. And if you can see, the net profit has gone from 378 last quarter, so 735. And if you look at just the top line growth, they have been growing extremely well over a long period of time. Obviously, the size is kicking in right now, but they have been growing extremely well. And their PAT margin, which is profit after tax margin, currently sits at approximately 45% at this point. And their profit growth is also going up quite well, right? So these are some very positive and bullish signs. And let's look at some KPIs. Again, I'm going to show you one table. If you look at the KPIs of these companies, because it's very important for us to learn all of this, right? The first KPI is total transacting users. The more the transacting users, the better it is for Groww. So we see that in this quarter on quarter growth, they have 24% growth from a year on year perspective. They have 2.2 crores total transacting users. If you look at the total customer assets, they have 3. 2.6 lakh crores of customer assets, which has gone up by 38% year on year. Net inflows this quarter was 23,000 crores, and their direct mutual fund AUM is 1.9 lakh crores that they have. Now they are basically launching the regular mutual funds as well, but the direct one was that big. If you look at their average daily turnover in the stocks market, it is 15.1, again a 3.3% change on the year-on-year perspective on the positive side. The biggest growth is coming from the MTF book. It went from 1,000 crores to 3,700 crores. That means there are so many people who want loan against securities with Groww, and this is what they're doing from that side. And their market share has now gone from 1.2 to 2.7, and they're indicating that it will go up even more from this point. If you look at Groww AMC, which is a cash-rich business, their own mutual fund business, that has gone from 2,286 crores of AUM to 5,491 crores, which has gone up by 140%. They usually make 0.3 to 0.5% as the expense ratio on this, right? So what is happening? Where is the operating leverage playing out? Let me show you another table on this, right? First things first, the cost to serve, okay? Their cost to actually provide all of these services is 18.3%. Their cost to marketing is 11.9%, and their cost to operate is 14.6%. But the revenue is obviously created much more, and that is why they're making even more operating margins and operating leverage. And that's why their EBITDA doubled when the revenue went up by 63%. Because now what is happening in any finance company, once you hit scale, right, the cost to operate, cost to serve, and cost to grow becomes very less. But the revenue that you make actually becomes much, much bigger. And that is why they made a lot of money. So basically, why are the DIIs buying, in my opinion? Number one is PAT has doubled in 1 year, okay? And margins are expanding every single quarter. The PAT margin is at 47.5%, and it expanded by 7.6% year on year, which is crazy. And this is annualized PAT. This annualized PAT could also go towards 3,000 crores by FY27. And again, it is growing very fast. And for a company that is already sitting at a large cap valuation of 1.26 lakh crore, I think even looking at a high growth perspective, the P ratio that they have over here is still at 50, which is quite good. And the PEG ratio is at 0.7. So even for such a large cap company, they are currently sitting at attractive valuations. Number two, I feel another investment thesis on this for the DIIs buying is I feel the MTF is actually a hidden gold mine, which I think will explode, because 3,500 crore book with 2% market share is nothing. I feel that will go up much more, and they are making a yield of 15%. They're selling it at interest rate, right? So if this MTF book goes from 3,000 to 6,000 to 9,000 to 12,000 crores, which looking at the market it will go, then this will grow even faster. And this is assuming that we're in a bad market. If the market changes, we go into a bull run tomorrow, this MTF book will explode, the AUM will explode, the brokerage will explode. So this is in a bad market, they're doing this well. In a good market, they will explode even faster, right? And then commodity derivatives, they had zero market share in the past. Now they have 28% market share in just 18 months. So they have gone very fast in commodity market as well. And that is something that is growing really well. Their AMC business again doubled in 1 year. And if the market continues the way it is, then it might go up again, right? So this is very interesting. And even SEBI and CCI approval they got for State Street strategic investment. So they are now taking a good amount of investments into their AMC business as well. Basically, they want to make the cost even lower and they want to grow faster. And they have some new products coming up which has not even added to this top line. First product, they have recently got an approval to list US stocks via Gift City. So that is again coming up. Once US stocks come, imagine the brokerage on that, right? Second, they have launched something called W by Groww, which is basically a wealth advisory for HNIs. And they have launched bonds are also coming up very strong, apparently by the CEO saying that the bonds market will do well. So all of these things are coming up in this market. And this is why the DIIs have been constantly lapping this company up, because it's very clear that at least for the next few years, this will become a cash machine that is going forward. Awesome. Chalo. I hope you guys enjoyed this till now. I hope you guys are not getting bored. Let's go to stock number 2. Okay, stock number 2 is Meesho. Now, Meesho recently launched, a lot of people didn't talk about it, but Meesho launched IPO, fell down this year itself, literally a few months ago, and now it's come back to 185. But if you look at the shareholding of this company, again, you can see that the public shareholding has gone down from 73% to 69%. DIIs have gone from 5 to 9%, and FIIs have gone from 4 to 5%. But why is this happening? Let's understand that as well. So if you look at Meesho, they are one of the largest e-commerce platforms today by annual transacting users. Okay, so they have zero commission marketplace for sellers, and they mainly focus on tier 2, tier 3, tier 4 India at this point. Okay, now where do they make money from? So they have, I'll show you a table again over here. They basically have a marketplace where they have a platform connecting buyers, sellers and logistics, and they make money from ads revenue, and that contributes to 95% of their total top line revenue. So ad revenue is very big for this company, and that is what is very interesting. If you look at some very key interesting metrics, again for them, they have annual transacting users that has grown from 264 million to 274 million in one quarter. This is not last quarter to this quarter. This is basically in 3 months, right? And if you look at the number of orders placed are also very high. The merchandise value has gone up, contribution margin is around 4%, and their free cash is still negative at this point, but they have around 6,500 crores of cash still sitting in their account, right? Then they have started something called new initiatives. Now, in the new initiatives, they have started their own in-house logistics. They have started BNPL, which is buy now, pay later, and they've also started providing digital financial services, right? So logistics fees and financial services is something that they have started. It's still very small, but they are basically now slowly growing at this point. Chalo, let's do a quick financial analysis of this company. So as you can see here, the sales of this company quarter on quarter basis are growing extremely rapid. Yes, it is still a loss-making company, but what happens? Platform companies, the minute they switch from loss to profit, they start doing extremely well. I had done this video on my channel on Paytm long ago, but many people ignored to watch it, and they had a classic story of loss to profit, and that loss to profit actually did really well on Paytm, and they started making a lot of money. And obviously when that happens, the share price starts growing as well. It's the same thing. And this company also is giving clear signs that they're going to do a loss to profit very soon, because most of the capex would have been put in the growth phase. Now they have already grown. So as you can see, the EPS is slowly becoming better, and very soon it looks like they will start going into an aggressive phase, right, where they will start showing profit. And when the profit comes, everyone will be shocked as to, oh my god, what happened to this company? Why is it suddenly going up so much, right? So that is what we're looking at. And if you look at the EBITDA, another very interesting thing is, which is the EBITDA that they had. Earlier, the EBITDA was negative. Now the EBITDA is slowly turning positive over a period of time. So recently, their EBITDA has gone to positive 0.2%. Yes, nothing great. I think it still needs a little more improvement to happen. But when that happens, it becomes very interesting to look at. Now coming to the investment thesis. Why are DIIs buying this? Number one, I think they have 264 million users. Only 30% of Indian smartphone users basically shop online. That means the TAM is still exploding. Their CEO, we went to their con call, and their CEO said even in other emerging markets, the number is north of 80%, and India only has 30% penetration of online shopping. And we believe that give it more time, this will actually grow into a much bigger segment going forward. And they are very bullish that more and more people will start buying when they come onto the platform, mainly in tier 2 and tier 3, which is where they are actually looking at. If you look at the adjusted EBITDA, they're very positive that because of launching the new financial services and their low cost logistics network that came into the market, they believe that in the next few years, this will start giving good results in EBITDA. We know financial services is great because once you create such a big user base, you sell them anything in the financial services industry, it will actually start doing much better. And that is basically what they're playing. And as you can see here, as I told you, their adjusted EBITDA is slowly becoming better. Their contribution is becoming better. So hopefully they will start, moving towards a profitable zone very soon, right? Another thing why I feel is ad revenue. I think ad revenue is still at the beginning stages of India. I think this will again explode because more and more brands want to reach tier 2, tier 3 and tier 4 India. And I feel that will basically become bigger. And also the recent acquisition of Valmo and their automation with a low logistics provider, which is going to give them more contribution margin. Their margins will become much better and this will start expanding again. Now they have also launched something called Meesho Mall. Now this is a Bharat brand distribution play that national brands won't ignore. They will start coming into this as well because now they are going to tie up with national brands and they are going to sell it in tier 2, tier 3 India. So a lot of positive things are happening in Meesho and that is why I think the DIIs are buying. Awesome. Cool. I hope you guys are enjoying this. We have one more company to cover. Please don't get bored. Okay. I'm going deeper into each company to just show you as much as possible. So the third company, which many people don't like, is actually a company called Ola Electric Mobility, right? Sitting at 17,000 crores and it has fallen like there is no tomorrow, right? Complete fall. IPO came out at 130 and now this price is sitting at 37. But our job is to not be, our job is to look at it from an investment lens, whether it is profitable or not, and is there a turnaround happening so we can capture the bottom. If you look at Ola, the DII holding has gone from 5% to 2% to 12%. Why has the DII gone from 3% here to 12% here? What is happening? FIIs are continuing at 4% and the public shareholding has gone down. So even though there is so much negativity around this company, what is happening in this company that the turnaround has suddenly happened in this company? That is what we are trying to look at, right? If we look at the revenues quickly, let's understand the revenue as well. So revenue, obviously they have not been doing very good. And if you look at the sales have been dropping every single year. But if the sales are dropping every single year, why are the DIIs actually buying, right? The sales have gone from 600 to 265. Ather Energy has overtaken Ola. Ola is not doing really well right now. Bajaj, all the companies have actually overtaken Ola. But even at a 265 crore top line, their loss is actually less than what they were making when they were making more money, right? So now if you see, the expenses have gone down quite drastically from 1,300 to 546. And now they are sitting at minus 500 crore profit. Obviously, this is still loss making. It is definitely not a good sign. But what is actually playing out right now? Let's understand that a little bit more. Okay. So right now, if you look at Ola Electric, they are 100% auto business. Okay. They have recently launched a cell manufacturing facility, a gigafactory, and that has basically made 20 crores of revenue right now. But it is nothing compared to the amount of revenue they're making overall, right? The deliveries are actually not doing really well. The deliveries have actually dropped over a period of time. The revenue has dropped over a period of time, but the gross margins have started becoming better because now they have started focusing on automating most of their stuff. And that is why you see the expenses have come down quite a bit. And this is the first time in Q4 FY26 they ever had a positive cash flow from operations this quarter. This is the first time that they actually became cash flow positive, which is again a very interesting news. You can see this here. They've had a strong gross margin expansion. They went from 13% margin to 38% margin, right? Because they're doing everything in-house. So they basically have everything. As you see, it has vertical integration. So they have everything in-house. So they have full cost control of things. If you go down and you look at the operating expenses, they have reduced their operating expenses from 844 to 428. That means their operating leverage is going to come down and they're continuously obviously firing a lot of people, getting more rationalization in the business and making everything more stronger because they realize they can't play in the same range as this, right? Apart from that, now they have the capacity for 1 million vehicles annually and they have a 6 gigawatt scale up coming with their other business as well. So all of this is basically getting into this. So they have the service business, which is their auto business, which is obviously not doing really well, but they're saying that the sales recovery has started across states for their Gen 3. So Gen 3 sales have started picking up and that is their basic business, right? I'll show you one more KPI sheet, like a table. So in this table, they basically remember last time they had a problem with their service and you saw on Twitter a lot of problems happened. So now their service average time to close or time to attend has gone from 9 days to 1 day. Service backlog has gone from 14 days to 6 days, right? So they have reduced their service backlogs by almost 50%. And the warranty cost has also reduced a lot because they've made it very good that now most of it has been done in-house itself. And now they are giving very aggressive guidance, but this I will take with a pinch of salt. They had 22,500 orders this year for Q4 FY26. They are saying by next quarter, we will have 42 for 45,000 quarter on quarter growth. I mean, if it happens, it will be mind blowing. They'll become profitable, but that is very difficult. But what they're saying from an EBITDA break even level, every quarter, every month, I need 20 to 25,000 orders a month. Right now, they're doing 20 to 25 orders a quarter. They need to convert that to 25,000 orders a month. If that happens, they will become profitable, right? Now coming to their gigafactory. So they're saying that they have a gigafactory of 2.5 gigawatt. Which eventually they will scale up to 6 gigawatt, which I already showed you here. And now they are going into execution of a lot of AI and stuff like that, which again, I'm not sure how much that will actually benefit. But what they're saying is once they become 6 gigawatt capacity utilization on that, eventually they'll go from 6 to 20 also, right? And they want to start providing these cells to other people as well. So that is basically what is happening in this company right now. So what is the investment thesis over here? Why are DIIs buying? In my opinion, I might be completely wrong. Number one, that gross margin has gone from 13% to 38%, which is crazy. Okay. Second, when the margins have gone up, your operating cost has come down from 800 to 400. You have literally halved it. And now your number of units have come to 25,000 a month, right? Which is, no, sorry, number of units have come to 25,000 units a quarter. And now they're saying their goal is to hit 25,000 a month so that they can get break even. And please understand, right now they're only doing the two-wheelers. Now they're going to come out with bikes. And eventually, because they have entire backward integration, they can launch anything and everything they actually want to, right? And they are saying that volume recovery for them will be V-shaped. V-shaped means it will be a sharp growth and demand constraint, not supply constraint. So they're saying that supply is there enough, but we have to focus on the demand and we will start getting the demand as well, right? They had a crisis of product. If you remember, everyone was asking for warranty and replacing the parts. That was 555 crores in FY25. This year, it's only been 59 crores. So they have reduced that by 1/10 as well. So motorbike market, which is today 2 times bigger than the scooter market, that is also going to come out very, very soon. And that is something that everyone is looking at. Even their bikes already has 15% of the orders are already filled. So this is something that is going to play out very soon for Ola. But again, we have to watch. I will not buy now. Obviously, I don't have any of these companies. I am only waiting for the inflection point. I want to see where that inflection point actually comes, how the turnaround is happening. Only then I would take a selective measure to invest or not invest. Okay, but see, the reason I do these videos, I'm going deeper because I got feedback that please go deeper. So I'm going deeper into it to try to explain to you what are the different factors that have happened in the company, how is the revenue changing, what do they actually do, what are the turning points, and why I feel the DIIs might be buying. So that is what I've done with all three companies. And don't worry, in the comment section below, I will pin the link for this document as well. So you can go through this document aram se. There is no buy or sell recommendation in this. It is just purely fundamentally driven document. So I want you to go through this document, read it and understand as much as possible. And again, if you guys like this video, please click on the subscribe button because we are doing a lot of content now to actually, improve your journey into the world of finance. I hope you guys enjoyed this and I hope you guys like this. This is me, Shashank Udupa, signing off. Take care. See you guys. Bye-bye.